Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residences so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
I'm here with a hurt elbow.
How'd you hurt your elbow?
It's so dumb. I hit it on a towel rack
Okay.
like a week and a half ago, and my fingers still feel a little numb.
Oh,
like
man.
I think maybe I tweaked a nerve or something.
Man,
Getting old is
tough.
lame.
Man, so
I
have you,
feel like
have you
if-
thought about seeing the doctor?
No.
No, because you're afraid insurance won't pay for it?
Oh yeah, total scams.
Yeah, that's actually what I want to talk about today is your hurt elbow and insurance.
Yeah. Insurance.
There's something going on right now
Oh,
in the U.S., probably around the world, which is kind of interesting.
with insurance?
Yeah, with insurance. What was it? I was talking to somebody about it. I saw a video, and then I read an article about it. I was like, okay, this is clearly a thing. It's becoming a thing. We got to talk about it.
Is this like
And-
all forms of insurance, or
No, home liability insurance,
Home insurance,
in particular. It's
alright.
probably all forms in general, but I'm specifically like we're a real estate podcast,
Right.
so talking real estate. And so, yes, I want to talk about it so that you are aware of what's going on, and what I'm going to share is some insights from the stuff that I've seen and read, and then some actionable advice that you can take from all of them. I've got 6 that we're gonna. Yep, no backside.
I'm intrigued.
That I'm gonna blast through here.
All right.
Okay?
Ready.
So let's talk about it. All right, number 1 is just the problem, is that there's a rising cost and unavailability of home insurance.
Okay.
Okay, so the home insurance market is increasingly becoming unstable, and that is you will hear some bias in these articles that I am repeating, but they're like there are more frequent natural disasters, and climate change is getting us, and so insurers, or perceived climate change, we'll put it that way.
Sure.
So insurers are either withdrawing or significantly increasing their premiums. Okay?
Right, because
Which is-
they don't want to pay out more money.
Yeah, right. Yeah, exactly. And there's a few reasons behind this. Those are kind of like the 2 top ones, but there are more things that are playing into this particular problem here. And so my advice at a very top level is research the insurance landscape in the area that you're considering for investment and take into account some of the factors that I'm about to share. And you especially want to pay attention in regions that are prone to natural disasters. So think hurricanes, earthquakes,
tornadoes,
floods, that kind of stuff. So like Florida is one. But it's not just the fact that there are more frequent natural disasters and things like that. There is this paradox that has been emerging in real estate, a paradox of increased real estate demand and insurance availability. Okay, so here's what happens is you have a whole bunch of people who want to live in a particular place, so the density goes up. And so let's say you have a house fire like in a rural area.
Yeah.
No big deal, right? I mean, it is to that family,
It is,
but like
but
that
yeah.
house goes down, okay, we're done.
Yeah.
But if you have a fire, let's say in Paradise, California, where it's a whole bunch of neighborhoods together,
Just
one house happens, the entire neighborhood goes down.
Yeah.
Same thing happened in Hawaii recently. And so that has become a problem. So places in like Florida, California, and Texas are the ones that are facing the most severe insurance increase. And yeah, and so it's just weird, like more and more people want to live there, but insurance is becoming more and more expensive. And so there's this demand supply curve
Yeah.
thing that's happening, and we haven't quite found that equilibrium
Strange.
yet. Yeah, I think it's in my next one. I'm going to talk about the role. Yeah, the role of government policy and mitigation risk, which is super fascinating on what's happening there. So here's my actionable advice: don't invest there. I would explore secondary markets, places that are a little bit more spread out. So Corvallis, Albany, Willamette Valley, just in general, is definitely one of those secondary markets. You may not need to go to tertiary, but that's even more
Rural
more
or-
removed, rural, that kind of stuff.
Interesting.
Yeah, I think is safer just from the insurance lens. Obviously,
Sure.
that's not the only thing that you look at. You got to look at the market as a whole and the investment it's specifically. There's 8 different things. But
right.
insurance needs to play into one of them. And it's worth just considering, all things being equal, I would go where there's less dents.
All right.
As a result of that. Yeah.
So is it like insurance is available, it's just super expensive, which makes it like unaffordable or unattainable?
So, number
or is
3.
it just not even available?
The role of government and policy in mitigating risks. So places like California have noticed the insurance premiums drastically increasing.
Yeah.
And so they have set caps saying, sorry, like you can't increase it any more than that. That's unfair to people. And so insurance companies are like, totally makes sense. We actually lost money last year anyways, so we're out.
Oh, they're just
Yes.
closing down.
Yep. And so it is becoming increasingly more difficult to find insurance. Or the other game that they're playing is they're saying, okay, we'll offer them a cheap rate and we'll just increase everybody else 5%. And we'll make up the money across the rest of the nation while keeping that level.
Interesting.
That's actually the thing that happens with rent caps.
Because there's only caps in certain locations where it's more dense.
Yeah, that's a classic thing that happens with rent caps in general, where you go, well, I have current tenants and I'm kind of stuck on how much I can raise it. So anyone new who comes in, you go, well, I'm going to make up for that difference. And so you set it at the top of the market. And so it actually creates this entire run up and to the point where everyone who is in a space, they go, oh my gosh, it's gone up so much I can't afford to move.
Right.
And so when you increase it by the maximum amount, they're still not going to move because they're still under market, because it's just, it creates all sorts of weird dynamics. And so now we're seeing that in the insurance game as well. Another thing that the government is doing is they're implementing programs like the FAIR plans, the Fair Access to Insurance Requirements. Essentially, what they're doing is they're saying, you know what? We, the government, will offer insurance instead of having it being privatized.
Okay.
Insurance for all
Yep.
is the idea. I'm sure that will be fine. Just like all big programs.
If they have to pay things out, they'll just print money and pay it.
I guess, right? Why not?
That's kind of what they do.
Yeah. So my actionable advice for this one is to stay informed about those government-backed insurance programs, or at least make sure that your sponsor is paying attention to what those options are, because they might be better rates. But you got to pay attention to what the coverage is for those, because they may not actually be better in the long run.
Yep.
You just got to pay attention to
Reminds
that.
me of health insurance.
Yeah.
Where it's like, oh yeah, this is way affordable, but then you're like, oh, it covers 2 things.
Right.
And so you're like, well,
yeah, similar bucket.
actually
Yeah, that's kind of
not.
what happened in the health insurance region with government care options is happening for home insurance now. Yeah, it's kind of weird. There's this thing called aggregation theory, which is the idea that if things can be aggregated, they will be and should be, and it's more efficient to do it because you get a whole bunch of economies of scale.
Sure.
You see this with, you saw it like famously with Google, right? We figured out how to make it super easy to find things on the web, and they aggregated it all, they won. Facebook figured out how to aggregate relationships on the internet. They aggregated it all, they won. Amazon figured out how to aggregate all products for sale. They won.
Yeah.
And insurance, I think, falls into one of those categories as well. And these are generally winner-take-all types of categories. Whoever can aggregate the best ends up winning.
Yeah.
You think about it from Netflix, right? Like if you could only have one service, you're like, well, I'm going to go with the one with the most shows.
Sure.
And for most people, they're not going to subscribe to multiple things. They're going to buy a product from one place. They're only going to do a search from one place. You're only going to look for hotels and flights from one place. So whoever has the most comprehensive ultimately wins. It just becomes a snowball effect.
Yeah.
And I think potentially you could see something like that with insurance, and if the government steps in and says, either home insurance or even healthcare insurance, they get the aggregation piece to it. They go, well, we can offer all these things for all the people at the cheapest rate. You go, oh, that one wins.
Yeah.
So I think that's playing a little bit into what's going on here. It's kind of interesting. All right. Another insight that I had kind of taking all this in is that you can use insurance as a leading indicator of market shifts.
Okay.
So insurance availability and costs, if something becomes uninsurable, they could potentially experience some rapid declines in property values, or at the very least liquidity. And so it creates both opportunities and risks. So again, Southern California is or California in general, it's creating a liquidity issue because people are like, well, I'm not going to buy a new place because I can't get insurance, and I'm not going to sell because my insurance rate's kind of locked in and it's so good. So there's all sorts of weird issues that are happening there. And so I think if you start to see insurance go nuts because they've got professionals who study this thing and they're doing actuarial tables and trying to figure out the probabilities and the risks. If you see an area where the costs are starting to go up, go, ooh, there's something going on here. I need to pay attention to that because they are not all going up equally. I think is the thing that is important to that.
Makes sense.
So you want to find a sponsor who monitors insurance trends pretty closely as a barometer of future market health and movements. Would be my actionable advice for that one.
How do you do that?
How do you
how do you know what insurance rates
so for me, I've got an insurance guy who's awesome. His name is Ben. We talk all the time, and that's what we do. We regularly talk. We connect base.
Sense.
Whenever he comes to Corvallis, we try. We grab lunch. We just chat. I mean, we talk a lot about life.
Yeah, because he would see a broad spectrum of different properties and different.
Yeah, and I can ask
rates.
him like, so what are you seeing like for the trends, and what are your thoughts for this and that, and and I can get that kind of insight from him. But
Makes
yeah.
sense.
And again, it's just one factor.
Yeah.
So you may still go like, yeah, I get it, it's rising. Whatever.
Yeah.
I don't care. I got a triple net lease on my industrial buildings. It is what it is.
Yeah. Might still work.
Yeah, exactly. Okay, these last two are alternatives that are starting to pop up to it, and there's pros and cons to them. So the first one is just self-insurance and risk pooling. So again, I think there's a lot of parallels to health insurance where essentially you have a bunch of institutional investors, the really big guys who are like, hey, we'll essentially do our own insurance. We'll either self-insure or we'll do group insurance, but not like we won't become an insurance company. We're not available to everyone. But hey, the 5 of us, we all like each other. We're all going to pool together. And if something happens here, especially if you have a bigger portfolio, they go, I can just self-insure this sucker. Yeah. You're required to have insurance if you have a loan. The lender requires you to have it. And so and they just go, yep, we've formed our own insurance
agreement or whatever.
What do they call it? Like in the health insurance space. I feel like I can't remember this term at all.
Provider?
No, it's like when you pool together as a big group. It's like a co-op.
Oh,
that
a co-op,
kind of yeah.
Which we
it's kind of like that.
We kind of looked into a little bit with the health side of things.
Correct.
Because it's like, I mean, it totally makes sense if you're like, all right, well, if it's just as expensive to pay out of pocket for certain things, like why in the world would I pay this premium if I'm going to pay out of pocket for other things that aren't covered?
And oftentimes it's just catastrophe insurance.
Right.
So you have ideally you have really low premiums and you just have a high deductible essentially. So it's just for catastrophes, which is how we do all of our properties. We self-insure.
Well, and honestly, for properties, it's kind of like that makes sense because if something were to happen to your property, it's probably pretty rare that you would have that amount of cash in your pocket that you're like, oh, I can just cover this $50,000 fix or whatever, which is similar to health insurance. Like you need the big stuff covered. Yeah,
exactly. So there's more companies who are doing those kind of things. It's a little more complicated, but they're like, hey, we kind of all set our own costs. And if something happens, like we decide, okay, we want to have this much in the account, and nothing happens because we all manage it really well or whatever. Yeah. Cool. We'll all just pay it back out. What we paid in. So there's things like that. The other thing, and I kind of hinted at this, is you just don't get a mortgage. Just cash. Go the whole way. Your return on investment is going to be a little lower because you don't get leverage, but if you pay cash, you're not required to have insurance.
Interesting.
And your cash flow is going to be significantly higher. You're not required
to have any type of insurance.
Correct.
Oh.
Or maybe you get like some super, super minimal something.
I don't think I knew that.
But yeah.
Huh.
Yeah, no, so like, for example, last week when I was talking about that haunted house property, I was like, I'm just going to demolish it and turn it into dirt. Yeah. I wasn't going to get insurance on it. Right. I didn't care.
That makes sense.
Well, it's that same idea. Like, I didn't have a loan on it, so I didn't have to have it.
Interesting.
And in that particular case, I was like, I don't even want it. Like, if it burns down, that's better for me.
If we were to pay off this house, would we... Like, would that requirement go away to have insurance?
Yep.
So weird.
It's just...
They want to make sure that...
It may not be smart.
Like, if you lost the property, they want to make sure that you'd be able to pay off what you owe for it.
Yeah, the lender's the one who's like, we want to make sure you don't burn down your property and go,
Oh,
that's
sorry.
a bummer.
Yeah.
I don't know how you're going to get your mortgage back. Like, that's not what they want.
Right.
So they require it. But again, if you don't know anything on it, it burns down. Who cares? Like,
Yeah.
I guess it's a bummer for you, but no one else cares.
Yeah.
So that's the idea.
Weird.
So what I would do from an actionable standpoint is I would just try to understand what the all cash purchase looks like.
Mm-hmm.
And if someone's coming at you with that and they talk about the insurance, I think the questions I would start to ask are like, okay, so what do you do if the place burns down? What are the plans for this? How are you mitigating it? Are you part of a pooled thing? I don't know. So I wouldn't just, I think we're getting to a point where as a passive investor, you can't just assume, and there's insurance line item. You got to actually ask a couple more questions. I still think 90% of the time that's going to be the answer. It's like, we just got regular insurance. But it's worth just like having that extra eye on it. And if you see something weird, you should probably ask about it, because my guess is this it's being affected by one of these things.
Yeah.
That's especially true if you're investing in a high densely
density.
populated area, because the chances of something happening are dramatically increasing, and insurance companies are reacting by dramatically increasing prices or limiting the options slash just leaving altogether. It's something that's happening. And I think if this trend continues, this is going to be something that will probably come to a head in the next like 5 to 6 years, is my guess. I don't think we have to worry about it with this current administration. They're just focused on rent rates in general,
Yeah.
which they don't need to anymore because they've all flattened out, but whatever. But I think next administration, I would not be shocked if that was a talking point about insurance and stuff like that.
Interesting.
Yeah.
There you go.
There it is. That's a little bit about what's happening in the insurance space. Kind of a scary thing, but I still think manageable, and I think could potentially provide some very interesting opportunities as long as you're walking into it open-eyed.
Yeah.
There you go. And if you also found this very interesting, we would appreciate it if you left a rating or review wherever it is that you listen to podcasts. And if you would like to learn more about investing with us, you can check us out at furlo.com. Thanks again for listening, and have a great day.